controversial is this, you say? Well, about 2 years ago, Hiive was getting started. A company that is basically made to allow trading of private stock. Sim and the rest of the team were sending out emails to folks, really trying to solicit it and try to get more people to buy and sell private stock before it goes public. And a reply came back. And it is, you can read it on the screen, and literally says, "I'm sorry, but I, as well as most VCs, strongly disapprove of liquid markets for private companies. They're private for a reason." My favorite part of this email, by the way, is the last line, which is, "Please don't respond, because I have no interest in engaging in the subject." Clearly, this person thinks private stock is not meant to be traded. Now, this person, I will not name by name. However, you all know who this is. We'll put it in that category of the level of this individual. So clearly, they don't think private stock is meant to be traded. And that's what we're here to talk about. Is it? And specifically, is there a reason why this type of email should be sent? Is there a reason why this person would have this position in terms of what they think about these types of securities? So today, we will have a debate. And this is the structure of our debate, just so everyone knows a little bit. We're going to have a kickoff sort of intro argument from each side for 5 minutes each. Each side will then ask each other questions and sort of position themselves against the other side for 5 minutes each. We will then turn to you, and we have a section for questions, and you all can kind of ask and put in your arguments inside the debate. And then we will finish, and we'll have a rebuttal with closing statements from both sides for 5 minutes each as well, and that will bring us to the end of this session. Our debaters, Sim, woo! Founder and CEO of Hiive. Secondary market pioneer. He's been doing this for a long time. He's been trading private company stock, whether or not it's supposed to be traded or not. He's been doing it for a while. Alon, woo! Founder and CEO of Aption. He has a deep resume. He has been the CFO of Bringg, the COO of Seeking Alpha, and the CFO of Natural Intelligence. Things that we have heard of before, companies that have made hundreds of millions of dollars. And our strong opposing side. So as we kick into it, Sim is going to open up with his opening argument. We will go for this for 5 minutes, as said before, and we will rotate from there. Thank you.
So the fundamental starting point for my position is that in a free market capitalist society, such as the one we live in, valuable assets, whether or not, whether they're goods, services, property, or financial assets, are presumed to be tradable. And so that's the default of our society. In free market economies like Canada and the US, it's accepted that free trading in valuable goods and services is good for society because it leads to economic growth. When people can trade freely, they're rewarded for their work and their efforts in creating value. They're rewarded for innovation. And this in turn leads to a stronger economy and prosperity for everyone. And it's not just good public policy that causes free markets, it's actually human nature. Human beings want to buy and sell things. If I have something of value, I want to be able to sell. If I have money, I want to be able to buy something that's valuable to me. I don't want somebody else telling me I can't buy or sell. So there are some reasons historically. So the premise is, the default assumption in our economy and our society is that things can be traded. There have been some reasons for restricting trading in our economy and in our laws historically. One of those is immorality or illegality, right? Drugs, prostitution. These are things we can debate about the morality of, but our society today has deemed these to be illegal and therefore not allowed to trade freely. Protection of economies. Duties and tariffs exist to protect economies. For example, you have to pay duties when importing wine into Canada from the US or Europe. Why? To protect Canada's wine industry. Again, something we can debate, but that is the status quo of sort of the legal opinion today, and or the legislative opinion in Canada, the public policy opinion. A final reason that's kind of legitimate is the inability of a party to be able to consent to a transaction, right? For example, child labor. You can't even pay a child to work for you, even if you're paying them a fair market rate. They can't agree to that transaction, or society deems that not possible, a transaction that's not possible. So subject to these types of restrictions, things should be allowed to trade freely, or it should be good for things to trade freely. And none of these restrictions or reasons for limiting trading exist in the context of private shares. It's not immoral or contrary to public policy for private stock to be owned or resold. The parties are adults and they're able to freely consent to the transaction. In fact, while there are no good policy reasons for limiting the trading of private stock, there are many good reasons for allowing it. Number one, liquidity is a good thing. All else equal, liquidity is valuable to capital markets and financial market participants. When liquidity goes up, risk goes down of financial assets. When risk goes down, the cost of capital goes down. When the cost of capital goes down, the value goes up. This is basic financial theory, and therefore liquidity is good for shareholders and companies. Second, there's no other way for private companies to get liquidity these days, or their shareholders. One study recently concluded that it would take 20 years for all of the unicorns today to exit at the current rate that they're exiting in the IPO and M&A markets. And that's assuming that no net new creation of unicorns. So there has to be another way. Third, transfer restrictions treat employees unfairly. If preferred stock gets to trade freely, then why not common stock? An employee works for 4 years, they have fully vested options, they already have to wait 4 years to get their stock. The stock takes 4 years to vest. They earn it over those 4 years. Once the stock is vested and they own the stock, why should they not be allowed to trade it and sell it and get value? Finally, without trading, free trading, you get black markets. And this is what we have seen in the secondary market today, is people trying to get around transfer restrictions by entering into indirect arrangements like forward contracts and other arrangements where the company loses control. So in summary, I only have 5 minutes, there's no fundamental reason to stop freer trading of private securities, and there are many good policy reasons to encourage it. Thank you.
And we'll switch. Opening argument from Alon.
So I acknowledge that there are many shortcomings of the relatively unsophisticated and illiquid private market that we experience today. Notwithstanding, opening up liquidity in private markets is liable to lead to disastrous consequences, both for venture-backed companies, issuers, and for the hardworking families they employ. Firstly is the issue of insider trading. Insider trading is a situation where you have one party who has access to good information and another party that doesn't have access to that same information, and the information-rich party takes advantage of the information-poor party and buys stock at significantly below what is a fair price or a reasonable price, a price that the information-poor party would agree to if they had the information. It should be noted that private market investors have significantly more access to information than their public market counterparties because of information rights that preferred stock confers them. Equally, private market information poor constituents, employees, have significantly less information than their public market counterparties because private companies don't have to share any information at all. So with freely traded private stock, you're going to have immoral players or unscrupulous players. They're going to take advantage of this situation. There's only one loser. Those are employees, those are hardworking families that have earned this stock, and such practices will erode their wealth and their equity. Secondly, we can look at public markets and look at what happens when you have thinly traded stock of micro-cap companies. This leads to generally downward pressure on pricing, and it leads to blocking access to capital. Pretty much every thinly traded micro-cap, small cap struggles to raise subsequent rounds, and when they do, these are often accompanied by egregious issues of warrants at questionable pricing that, again, wash out existing investors, shareholders, and employees. There's no reason to think why this wouldn't happen in private markets. In fact, there's every reason to think that it would happen in private markets. The value of any asset is determined by supply and demand. Today, the supply of private stock is 100% controlled by the issuer. They decide when, where, and how they go to market. And therefore, they have some level of control on how these transactions are done. That allows them to sell into market at prices that make sense for their capital needs. When you open up liquid private markets, that stock is more readily available. By definition, it applies downwards pricing pressure. On top of that, you'd be hard pushed to convince an investment committee to buy a stock at $300 on the new mark of a new round when they could have bought it at $100 in the private secondary market 2 weeks ago. With downward pricing pressure, you're going to need to block access to capital. There's only so much money you can raise at certain valuations. The actual existence of the liquid private market in itself will erode practically rights that preference shareholders have. They pay up for the preference shares to get rights such as preemptive rights, and with frequently traded stock, it's impractical to exercise these preemptive rights. Finally, I'd like to sum up with an observation from Jeff Bezos. He observed that had he had a different set of investors who weren't bought into 20 years of unprofitable growth, Amazon would have never become the behemoth that it is today. Venture is inherently risky, it's tough, it's the long haul. And if your investors, your board, and your executives aren't aligned on how you're going to get there, you won't get there. When you lose control of your cap table, you lose control of that alignment. Opening up free public-private market trades erodes that alignment and erodes that control of the cap table. So to sum up, opening up private markets to trade is going to harm, first and foremost, the very employees that we're trying to protect, because we'll see unscrupulous insider trading and we'll see erosion of value in private companies. In free market economies, every good or service should be free tradable. How do you apply those principles to goods or contracts, manufacturers that very much have ultimate control on who resells, who distributes, who assigns the very products or services they're producing?
Can you give me an example?
Apple.
Okay.
Apple have complete control of their ecosystem. They decide where every single app, phone, widget goes.
But I can resell my Apple phone.
Not a new one.
Not-
They have complete control.
So that's like, okay, so I would say that's analogous to a primary issuance of capital, but we're talking about a trade, so a resale.
And how about contracts? If you do a services contract with someone, you want to assign your responsibilities or rights. Frequently you can't without the counterparty's agreement.
Right, so services, in terms of like assigning your rights under a services contract, is an interesting case. Actually, well, I happen to be a lawyer, but I have a small amount of knowledge, which can be interesting. But you know, in common law, you actually cannot. There's a principle of common law that you cannot force someone to perform on a services contract. So if someone breaches a services contract, you can seek damages from them, but you can't get what's called specific performance, meaning that you can't force them to do the thing that they agreed to do with you. You can only collect damages from them, because that's like tantamount to slavery or whatever, you know what I mean? Like, you can't force someone to do something. And I would say that the similar principle would apply in the case of the assignment of a services contract. If someone agrees to provide you a service, you can't then force them to provide that service for somebody else for the same legal principle. And I think there's good, kind of, speaking of the policy reasons for that, there's good kind of rationale for that. But we're talking about a financial good here, which does not impute that kind of moral implication about the free agency of human beings. It's about a purely financial asset.
how would you apply the principles that you outlined to earlier stage companies, seed, Series A, perhaps Series B, where founders and executives are expected to have significant skin in the game, and without them, perhaps the company takes a very different path?
Mm-hmm. Well, look, I think that can be handled by putting reasonable limits on how much liquidity that a founder can generate. In fact, oftentimes most companies do allow founders to sell something at a certain stage. The founders oftentimes also have some degree of control over the board, so they can approve a transaction for themselves. It's usually the smaller common stockholders, smaller employees who kind of get left out in the cold because it's oftentimes the founders and management who are stopping them from selling. And I think that the skin in the game point with respect to employees is that they, as I mentioned, they earn their stock over 4 years, right? So the principle of giving people stock options is that you retain them over the 4-year vesting period of the stock. At the end of the 4 years, they have the right to buy that stock. Well, if they have the right to buy the stock, they exercise their options, and they own the stock, then what's the rationale from that point for stopping them from reselling the stock? It's something of value. The retention value, the principle of retention has already occurred over those 4 years. Now they own the stock. That was their part of their compensation. Without the right to sell it, it's worthless to them.
And if private market stock can be freely traded, what's the point of having public markets?
Well, private markets are available to a limited number of people. There are, as you point out, there's a limited amount of information available on private companies. Private companies do not have an obligation to disclose information to the public, which is why regulations require buyers of private stock to have a certain level of sophistication, net worth, and so on, IAB accredited investors. So those protections exist, and the argument I would make is that these people are big boys, so to speak, the people who are allowed to buy private stock. And given the existing regulatory and legal framework, I think there's enough protections in place for those buyers. And so it doesn't replace the public market because it's never going to be available to everybody. It'll be available to accredited investors. So presumably you're saying that the buyer has information that the employee does not have.
Frequently.
Yeah. And it's also possible, I guess, that the employee seller could have information that the buyer doesn't have.
It's less likely. I mean, buyers frequently are either invested in the cap table or know people who invest in the cap table. They have information rights and can basically demand the company's accounting records if they want.
Right. So if there's a seller, but I guess the bottom line is that sometimes the seller may have more information, sometimes the buyer may have more information, but the bottom line is both parties are aware that there could be an information asymmetry. So if a seller says, employee seller, which we encounter all the time, actually almost dozens a day now are selling on our platform, says, I don't care whether this is a fair price. I just want a price that someone's willing to pay me today. I want the $500,000 for my stock. Could be worth $1 million, maybe, I don't know. But I'm willing to sell it for $500,000. Should they be allowed to sell, knowing that it could be worth a lot more?
No, I don't think they should. That same argument could be used to undermine the basic insider trading rules in public markets. You also have that information asymmetry in public markets, and buyers and sellers could know that information asymmetry.
But in public markets, there's an information disclosure requirement, so everyone is presumed to have the same information. So that's why insider trading rules exist, because some people are trading without. Some people are trading with additional information beyond what is available to the entire public, without the public's knowledge.
First, you still have people with additional information, mainly inside executives themselves, and there are rules around them abusing that knowledge. I don't see why the same shouldn't apply here. We're after fair markets. We're not after markets where rich get rich and the poor get poor.
Right, but insider trading rules also, assuming I accept what you're saying, which I don't, But insider trading rules are also intended to prevent the misuse of inside information, right? So if I'm a seller and I don't have inside information and I'm a grown adult and I want to sell, who are you to tell me? I'm a 40-year-old engineer, I spent 4 years working, I earned my options, I now have the options, I'm ready to sell them. You're going to tell me that because I don't have complete information about the company, I'm not allowed to sell?
We have plenty of laws in place to protect people. The loan market is regulated so that loan sharks can't take 60% interest rates on people that really, really need that money and can't get it from a bank. There are countless examples of this.
Which is similar to the sort of the third category I was talking about before, yeah, but when the party is unable to consent, effectively. So that's what you're saying is the kind of the case, is that an employee seller is just not able to consent to a sale, even knowing that
they can consent to it, but we should protect people being abused by people in power, either informational power or financial power, and we have plenty of examples of laws like that.
Cool. You mentioned microcap companies and how they suffer from illiquidity when they're able to trade. What's the typical valuation of those companies, like a microcap stock?
I think that phenomena we see that phenomena of companies that trade up to probably 5 billion.
5 billion, you see complete lack of liquidity.
No, I'm saying there are companies that trade up to market caps of 5 billion that are thinly traded.
But the really thinly traded ones are typically valued at 50 or 100 million and those types of companies.
Not only. I can give you many examples of companies that IPO'd, the employees tried to sell their stock options and had to drip those stock options over 2 months because the market couldn't take them.
So assuming that public companies, their stock trades, and then they tap the public market for primary raises as well. Why does this wisdom not apply to public companies? Why do public companies allow their stock to trade, but also raise capital from the same market?
Right, so that's the exact phenomenon I was talking about. Often that runs into trouble and those...
No, but like Coca-Cola does not...
Sorry, we got to wrap that. You can't keep going. Let him finish, and then we got to move to the next section.
So public companies that have significant investor bases and market caps and are well traded have access to that capital. Companies that are thinly traded simply don't, and to incentivize those fundraisers, they have to tack on all sorts of sweeteners and warrants and kickers, and that's just bad for existing shareholders.
Great. Out to the audience. Any questions for our debaters here who are getting into it now?
Distinction between common versus preferred shares. Are you guys going after the common shares as well, where there might be restrictions on selling?
Yeah. So common shareholders are by far the majority of sellers who sell on Hiive. Common shareholder share sales have to be approved by the company. So that's what the restriction is. It doesn't mean that necessarily that they can't be sold. It just means that the company has to approve the sale. I think the fundamental debate here is, should companies generally be more permissive towards these sales or more restrictive? So we will submit transfers of common stock shares. The company goes through the process and then approves or not.
Great. Other questions?
Yes, so question regarding the transparency. If you are like a newbie in this market and you're making your first trade, you want to buy SpaceX or Revolut, and you go on your platform, okay, there are dozens of them.
Yeah.
How do I know that the price that you're giving me is the market price? And there's not like a markup of 10% because of your greedy salesman people want to do it.
Right. Thank you for that question. That actually goes to the sort of the core of why we created Hiive, which is in order to centralize the trading of private securities in one place and provide parties with price discovery. So prior to to answer your question about SpaceX or any other security that trades very actively on Hiive, there's price discovery. So in other words, Buyers and sellers are the ones who determine the price. I'm a buyer at 90, there's a seller at 92, okay, we'll agree at 91, that's now the market price. Buyer-seller matching over time is what determines that price line over time. So for you can have the comfort of knowing when there's a more liquid stock on Hiive that there's not somebody there sort of taking advantage of you because that price has been established in the central forum by buyers and sellers acting freely.
Any thoughts on that?
One more comment. I'm actually the greedy salesman that works at Hiive, and we have a standard fee scale. So we don't mark up the securities arbitrarily. We have a standard fee scale between 2 to 5% that Hiive will take as well.
And any thoughts on that? Obviously not a question necessarily directed, but in terms of how you yeah.
I think transparency and price discovery in general is a good thing. There are many people that will argue that. I think the challenge is, one, frequently those buyers and sellers are blind to what's going on in the company in real time, and so that can be abused by insiders. And secondly, that mechanism of price discovery can create complications in fundraising. If there's a mark to your stock and you want to go out and fundraise at 30% higher or whatever, you've got a much harder job than you did before to raise at that mark, and that has consequences for the company.
So, Alon has already given his answer to that question, which is yes. My answer is no. In fact, it's the opposite. Liquidity, basic principle of finance. Liquidity begets liquidity. When something becomes liquid, it attracts more interest from investors, not less. So there are a lot of founders who believe, and they come because they come to the table as startups, brand new companies. Early days, they struggle to raise capital. Young companies have a tough time raising capital. Nobody's looking to trade young companies. 20 million valuation, 50 million, even 100 million. The minimum valuation of companies that trade on our platform are typically in the 3 to 4, 500 million US range at their last funding round, and the average one is in the billions. But when a liquid market for a stock arises, that's a signal to other investors that this is a liquid stock, and therefore it is less risky. Liquidity, the lack of liquidity of a stock, is a known risk factor for a private market investment. You take that liquidity risk out of the equation, and you make the stock less risky and more attractive to investors. So, and this is a phenomenon we see on our platform. Companies who restrict trading are making their stock illiquid. They're restricting the market. When investors know a stock does not trade, they're inclined not to invest in that company because they know that there's a high, all else equal. I'm not saying that investors are not interested in restrictive companies. Many investors are. But the liquidity of the stock, the potential to resell it, is something that will factor into a rational investor's decision making. So I think it's better. And liquidity is not a zero-sum game. There is not a limited amount of capital available to a company. A company can enhance the demand for its stock by taking a more permissive stance toward trading, but also by doing things like developing the market for their stock by, for example, selectively sharing information with certain investors in order to educate them on the stock. So there are many ways for a company to enhance the demand for their stock in the context of a liquid market.
And you did have a comment before in this space, but anything you want to add there?
The employees towards a future exit.
Yeah.
And doesn't the company have a right to say, we don't want you guys, getting 4 years of options, exiting before we get off, and then if you're an employee, you can cash out and leave the company.
Yeah.
Start the next thing, and the whole point is you got skin in the game, and it's you can't get out till we all get out.
Yeah.
So it doesn't create a misalignment when employees can cash out at any point and just leave.
Yeah, so great question. This is a common sort of argument that founders and boards make for restrictions. Now, first of all, that's not the premise of stock option compensation in the first place. The premise of stock option compensation in the first place, and that's the understanding that employees have when they sign on to a company, is my stock vests over 4 years. And the 4-year vesting period is the period during which I am retained by the company. In fact, it's a common practice of company management teams to refresh the stock options of employees every 2 years in order to maintain that incentivization. So in other words, 2 years into your 4-year vesting period, the company grants you more options so to retain you. But nobody at the time, neither the employee nor anybody else at the time, first of all, the employee never agreed that I'm gonna be here forever and I have to hold on to my stock until you exit 20 years from now. Employee never agreed to that. Number two, the employee never agreed to the idea that even after they spent 4 years earning those shares through the vesting period, that then they would not be able to benefit from the value of that stock. But going back, so I think I think it's not fair to say that that's the bargain between the company and the employee. I don't think that's the employee's understanding when they receive stock options. But the last thing I will say about the point of retention is that something that cannot be sold is of no value. And we are increasingly hearing from companies and employees that it's actually this retention value in allowing employees to sell a certain percentage of their stock every year after the 4-year vesting period, so after they put in 4 years, to retain them, to create an income stream out of those stock options and retain them over time. So I think that the wisdom on that retention point is actually already shifting, but yeah.
Any thoughts on that?
Yeah, I actually have to at least partially agree with Sim on this one. The actual reason that company gives stock options is because they can't pay what public companies can, and they're competing for the same talent, so you have to remunerate in some way. And so if you're giving someone a stock option that can't be sold, that you can't do anything with it, that's an issue, right? And that's, I don't want to say it's fraud, but that's an unscrupulous practice. What I will say is that the second that they become liquid and frequently traded, then there's a well-known phenomenon in post-IPO companies that employees sit there on Yahoo Finance refreshing and working out how much they're worth. And that's an incredible distraction to actually running a company. And so if you bring that into pre-IPO, management then have to deal with that as well. That's one of the other things, like a lot of what Tim's spoken about, disclosing information to potential investors, etc. One of the advantages of being private, you don't have to deal with any of that, and it's a huge operational overhead and burden, both sharing information, dealing with employees who are refreshing Yahoo Finance, and that I think is the flip side of it.
So I think that my honorable opponent here, the fundamental sort of gist of the arguments that Alon has made today is that because private companies do not broadly disclose information, that somehow their shareholders should not be allowed to trade. And the reality is that private company shareholders, whether they're employees, whether they're buyers, and we see this every day on our platform, we see situations where employees, senior employees of the companies have more information than the funds that are buying off them, and vice versa, that funds who have access to management get information about the company that perhaps employees don't have. The reality is that, going back to the principles of a free market, if two people want to do a deal, knowing that, and one party knows that the other party may have more information than them, or less, those two parties should still be allowed to transact, knowing that information. Knowing the fact that the information is not widely held. The other point, kind of key point that Alon made is about the constraint that this argument about the scarcity of capital, how companies that go public and allow trading, micro-cap companies or even startups that raise capital have scarcity of capital. There's only so much capital that's available to them, and therefore, if they allow people to buy their stock from other shareholders, then they're depriving themselves of the access to capital from those shareholders for primary fundraising purposes, in other words, to fund the company itself. That if I let people sell to that buyer, then that buyer is not going to be available to me as an investor into my company. And I would say that that argument is, first of all, the phenomenon that Alon described relating to microcap companies is something that exists for very small companies that probably should not have gone public in the first place. And it's something that does not, it's not the natural state of public liquid markets. The natural state of public liquid markets is large cap companies that have very active trading in their stock, millions of shares trading hands every day, and are not worried. They're not worried about their ability to raise primary capital or raise more capital. In fact, they go and access that same market, that same stock market, when they want to raise new funds for the company. And in fact, they use the secondary trading price as a benchmark for that capital raise. So liquidity results in more liquidity. Why does it work in the public markets? Because public markets are liquid. So if anything, the public market is an example or an argument supporting the idea that private companies should have more liquidity, because that's going to allow private companies to have more access to capital. And there are many things that private companies also can do to enhance the demand for their stock. For example, by sharing information selectively with certain investors to, for example, enhance the demand for their stock. The one good reason, and the one reason that I think underpins, just to conclude, the real reason why boards of private companies want to stop trading is because of access. Late-stage venture capital funds charge 2% management fees and 20% carry. And if you don't know what that means, we can talk later about that, to their investors. That is what I call an access tax. Because those venture capital investors have access to that company, they're able to extract significant economic rents from their own investors. If they allow the stock to trade more freely, then their investors will be able to access the company directly, and their capital access advantage goes away. So that's the real reason why boards of private companies stop trading.
Great. And to bring us home, Alon, closing arguments.
Thank you, Sim. Sim's fundamental argument is you have two grown adults who want to do a trade, and so why not shouldn't they be able to do a trade? And if you buy a ticket to the Eras tour, then Taylor Swift has decided you can't resell that, and she's decided that you can't resell that because she wants ticket prices to be fair. She doesn't want her fans paying $20,000 for a Golden Ring seat. She decides the price of that Golden Ring seat. There are plenty of examples in our markets of goods that are regulated in terms of price. Loans are one of them. Insider trading is another one of them. In terms of stocks, healthcare, the list goes on. We look at price regulation as a tool to ensure fair access to certain services, goods, products, etc. The premise that two grown adults should be able to do a trade generally is true, but it's not always true. And when there's a third grown adult in the room, which is the issue, which is the private company who issued the stock in the first place has a lot of say on what happens with that stock. The private company is Taylor Swift, if you will. And there's really good reason to prevent secondary trades in that stock. We touched on some of them. What does it do to access to capital? What does it do to pricing? What does it do in terms of, is it fair for your employees to expose them to unscrupulous trades and insider trading? Those are fundamentally the reasons why a private company may wish to remain private and control its stock. If it wants its stock to be traded, it can do that. It's called IPOing, and that's existed for hundreds of years. But private companies choose to remain private because they want control of their cap tables, they want control of their stocks, they want to exist in a certain regulatory environment and a certain contractual environment with their stakeholders and investors, because being private and building a company is really, really hard work. And you need certain tools available to you to make it to the end. Control of your stocks, control control of how you access capital is a major tool. It's the lifeblood of the company. So I think that is, in summary, why I would advocate for private companies to retain control over their stock classes and their liquidity, and may the best man win.
Real quick. Woo!